Welcome to this Killick Explains video on behavioural biases. I want to take a look at 7 of them, explain what they are, and offer some suggestions at the end as to what we can do about them. So the background to this is what? Well, basically a combination of hot weather, and let's face it, it has been pretty toasty recently, and volatile markets can be more dangerous than usual when it comes to being fooled by our own brains. We are more prone to what are called behavioural biases than perhaps before. And this is a good time, therefore, to remember what these things are and also just be alert to what they can do to our stock market behaviour. Now, first of all, what are behavioural biases? It's a rather grand sounding phrase devised by psychologists. So what does it actually mean? Well, basically it's jargon for things we are programmed to do, even if they're not terribly helpful in an investment context. Now, why do we do them if they're not helpful? Well, many of them are based on sound subconscious programming. They make us human, and our history and our biological programming is the reason why they exist. But that means as investors, we need to be conscious of them and able, by hook or by crook, to override them and not let them influence what we do when it comes to the stock market. So let's take the first one, hindsight bias. Now, this is also known as rear-view mirror investing, and it's the idea that despite the risk warning we get from regulators, we rely too heavily on the past as a guide to the future. And it can lead to several problems. It can lead us to not doing anything when we should, or irrational fear of missing out investing. I'll give you an example. When I started work in London in the early 90s, friends of mine lost money, substantial amounts of money on property in real terms. This was the early 1990s. So as a group, the rest of us avoided buying property for far too long. Yes, those conditions were bad. Yes, in the early 1990s, property was a mistake as a pure investment, but subsequently, as we now know, the property market performed reasonably well by comparison. So, rear-view mirror investing stopped us buying a property based simply on the fact we'd seen some bad news a couple of years before. Or it can lead people to do silly things. So people look back and say, well, if I'd bought Amazon on its IPO, look how much money I'd have made now. And you'll see that example quoted everywhere. And people then jump into the nearest unicorn stock thinking, well, this could be the next Amazon. Well, maybe, but crikey, you're not going to just jump into something that sounds a bit like an Amazon without fully understanding whether or not it is. Crowd following is the next one. Now, this is an easy one to understand, but a harder one to correct. Basically, on the open savannah, there's safety in numbers. It makes sense to stick with the crowd. You're likely to be protected by it to some degree. And to this day, we remain sociable creatures. We're obsessed with keeping up with the Joneses. We like to know what our neighbours are doing, and we like to think we're doing similar things. So standing apart is harder work and requires a lot more discipline, and it's something that not many investors are blessed with. The idea of being contrarian, the idea of being able to make up your own mind and judge the facts on their own and your own basis. But it's worth bearing in mind. Whilst following the crowd makes sense in many contexts, as an investor it can lead us to simply buy high after everybody else and sell low after everybody else, the opposite of what we're trying to achieve. Next, loss aversion. Now, you might think this sounds sensible enough, and up to a point it is. So this is the idea, studies have shown it, that we suffer losses. We hate losses more than we actually enjoy gains. We don't want to lose money, and fair enough. But it can lead us to be terribly cautious and actually not take on any risk. And the long-term damage to our wealth can be considerable. I feel sorry for people who saw the early 1970s stock market crash, where the market went down 2/3. They liquidated their portfolios, went to cash, never went back into the stock market. Or people who frantically sold as the coronavirus took effect earlier this year and then were too nervous to go back into the market, as we saw indices around the world not only reach their previous highs, but in some cases like the Nasdaq exceed them. So being overcautious, sitting on the sidelines in cash, is risky. You miss out on opportunities potentially, and of course there's the corrosive effect of inflation eating away at the overall value of your wealth to think about too. Next, survivor bias. Now, you come across this in all sorts of walks of life. This is the idea that we only tend to see winners and we never hear about losers. After all, survivors literally are the people who are still around to tell us how they did it, whether in business terms or anything else. Losers tend to keep quiet or tend to sort of disappear from the media, as it were. And we're also suckers for a good story, the plucky outsider who made it good. We imagine we could be that person, that survivor. But it means we can be manipulated by data. Now, hedge funds are a classic. Many hedge funds fall by the wayside. You tend to hear about the ones that are still in existence by definition. So watch out for performance data. Make sure you've got the full story. Make sure you know how many horses started the race, not just finished, as it were. And also, it can make us prone to look at survivors like being drawn like a moth to the light and saying, well, I could be that person. If I just took a big enough gamble on a single stock, for example, that could be me. Be careful. Next, overconfidence, and these are to a degree connected. So plenty of studies have shown that most of us think we are above average drivers, which statistically obviously is not actually possible. And a huge stock market rally like the one we've seen post-coronavirus, or the 10-year bull run before that, creates what I call a guru every day. People keep coming up to me and saying, look at how much money I made on this single stock in a morning. And we start to therefore confuse luck if we're not careful with skill and judgment. Maybe not the first time, but when stocks are rising sharply, it can be easy to sort of fall into the trap of thinking, well, I didn't know anything about potential cures for the coronavirus 2 months ago, but actually it looks as though I do now. Be careful. Simplicity bias next. Now this one is simply the idea that making money is actually quite hard work. If you've read Malcolm Gladwell, he thinks that to become an expert in anything takes 10,000 hours in his Outliers study. However, we're prone to look for shortcuts and fun. We like the idea that we can somehow shortcut the route taken by everybody else and enjoy the ride. And apps such as Robinhood, for example, try and gamify investing to make it as exciting as possible. Marketeers, of course, know about this, they exploit it, and you need to be careful. You can make work seem as fun as you like. Beanbags, regular breaks, you can make investing look like playing a video game, but at the end of the day, making money and investing successfully are both hard work. And finally, now, there are plenty others, but I'll deal with this one as the last one, confirmation bias. And this, I'm afraid, is the idea that we make selective use of data to justify our actions. We backfill. We say, well, look at where I am today, let's go backwards and pick out the facts that show me how I got here. And we ignore inconvenient facts and we start to confuse correlation and causation. Now, one way around this, as I say to people, look back at investment decisions you've made, look at how they subsequently panned out, good or bad, and think about whether that was what you were expecting. Don't just say, well, I made some money, it must have been the right decision. Be rigorous. Analyse past decisions, keep a diary of the reasons why you invested at the time, and audit your judgment against outcome, if you want to see it that way. Solutions, well, I've hinted at one or two as we've gone along. I'm going to condense this into just a few moments here. So, being aware of these biases is a good start. Accepting we're prone to them, not just saying, well, that doesn't apply to me, is a good way to start off on this journey. Investors, basically, I'm afraid, need to be rational, consistent, pragmatic, and long-termist. Investing should be quite boring, as one Nobel Prize winner once put it, like watching paint dry. If you're trying to make it exciting and sexy and fascinating, well, maybe you're falling into some of the traps I've mentioned earlier. In short, we all actually need to be a little bit less human when it comes to the stock market. And stock market advisors often are the kind of people you wouldn't necessarily want at a dinner party, but are good at recognising these human biases and effectively overriding them, not being fooled by their own brains, as it were. If you'd like to know more on what is a huge topic, editor@killick.com, and to watch videos related to this topic with a few more examples of behavioural biases, killick.com/learn. And finally, if you'd like a copy of my book, guide I should say, Killick Explains, Education Only, How to Invest in Equities, then please do email me, editor@killick.com, and I'll be very happy to send you the relevant link.